for all your tax needs and more.
Hi there. I'm Daniel Lader, founder of Lader CPA and Associates, and welcome back to our ongoing series, Tax Strategy, right here, right now, where we are talking about great ways to reduce your tax bill and skipping all the jargon. So this week's topic is going to be defined benefit plans and cash balance plans for high income practice owners. Now, this is a topic that gets a little bit into the deep end of things. So we're going to keep it light and high. This is a topic that if you're ready for it, definitely talk with a tax professional. So now, if your practice has been doing very well, a regular 401k can feel a little bit like it's the kiddie pool. So a defined benefit or a cash balance plan are more like the deep end with bigger tax deductions, but a lot more rules and responsibilities. So the goal, what I want you to walk away from this knowing, what these plans are in plain English, who they're for and who they are not for, and what the big win is, namely a larger deductible contribution, and what the big trade-off is, namely a lot more requirements. So first, what is a defined benefit plan? I'll try and keep this interesting, but a defined benefit plan is a retirement plan where the plan promises a future benefit, not just whatever has been invested. Now, because the plan promises a benefit, the business can often contribute and deduct more than with a defined contribution plan, but it's a lot more complex and costly to maintain. Now, what is a cash balance plan? Why is it a lot more popular? A cash balance plan is a type of defined benefit plan, but it looks like an account balance each year with a hypothetical account you want to reach. Now, the participant's balance typically grows with a credit or a percentage of the pay or a flat amount and an interest portion, either fixed or tied to something like an index. Now, the idea with a cash balance plan is that the investment, when it goes up and down, don't directly change what the benefit, the promised benefit will be. And the business, the employer, bears all of the investment risk. Now, why does this matter? Why do high income owners care? Well, these plans can create a large, legitimate tax deduction by allowing a much larger annual contribution than a normal 401k can, especially for owners who are older and want to catch up on their retirement quickly. Now, the catch is your deductible amount is not something you pick. It's based on actuarial calculations, and an actuary is required to compute this, so it gets a lot more complicated really fast. Now, there are a couple limits. Let's keep it simple. A defined benefit plan has an annual cap of how much can be put in. The IRS has this limit right now at $290,000 for 2026. Now that's up. In 2025, it was $280,000, but that's $290,000 that you can contribute into this. Now there's also a cap on how much compensation can be counted in the plan's calculations, and that's $360,000 for 2026, meaning your wages, your compensation, $360,000. Now, what does that actually mean? This means you cannot shelter an unlimited amount of your business's profits, but those ceilings are very high. So that's not going to be a big concern to a lot of high income owners. Now, what is the deal? The deal is there's a bigger deduction, but it requires annual funding. So a defined benefit or cash balance plan, they are subject to minimum funding rules. So the business must fund what's required for the benefits. Now, if the minimum required contributions are not made, the IRS can impose a tax on the unpaid portion of those contributions. Doesn't that sound awful? That is why these plans are usually a multi-year commitment, not just a maybe I'll do it, maybe I won't strategy. You have to commit to this one. Now, many private sector defined benefit plans are covered by a PBGC insurance. Don't ask me what the acronym is. You won't remember it anyways. But there's an important exemption for certain small professional plans, and it's generally tied to how many active participants you have. So practically, the PBGC insurance may be required, or you might be exempt if you're small enough, but you must confirm with your specific plan. Now, when is this kind of strategy a good, strong fit? And when is it not? Well, that's pretty easy. It's a strong fit if you have a very steady, predictable profits, and you can reliably fund this plan year after year. And you're already maximizing your 401k or other similar options for your retirement. And you want a very large deduction and accelerate your retirement savings. Now, when does this strategy not for you? That's easy too. When your profits are up and down or volatile or cash is tight. Clearly it won't work then. Or you don't want the ongoing high administrative costs. Yes, there are costs to doing this. Yes, they are higher. And you don't have staff and aren't ready for employer contribution benefits to work, etc. Basically, you're not ready for a long, expensive commitment, even if the payoff is great. Now, how do owners usually structure a defined benefit or cash balance plan? First, your 401k, fully funded. Any profit sharing related to that, fully funded. And then your cash balance plan comes in on top of that. The 401k will handle your employee deferrals and your normal business or employer contributions. The cash balance is that extra horsepower for the larger deductions. Now, coordinating between those three, it can get very technical and must be designed correctly. So again, talk with a tax professional about these plans. Not just any tax professional either. We all know what we're doing, but there is a specialized group that handles these kinds of plans too. A couple practical tips and what you want to do next. First, ask 5 questions before you move forward. Do you expect profits to stay strong for the next 3 to 5 years? How much do you actually want to save per year? Give us a real number. Do you have employees, and what contribution level are you comfortable committing to? Do you want flexibility, or are you okay with a retirement mortgage that you need to pay yearly? Who is on your team? A TPA, an actuary, an investment advisor, a CPA, and do they all work together? Good questions to think about. A closing thought to leave you with: a cash balance or defined benefit plan can be an incredible tool for a high income practice owner, but it's not a loophole. It's a trade-off. Bigger deductions in exchange for a bigger responsibility and stricter rules. Let me leave you with a critical thinking question. If your practice had to make a required retirement plan contribution every year, even in a boring or poor year, would that feel like security or stress? Next week, we will be talking about entity choice to reduce self-employment tax. The Schedule C versus the partnership versus the S Corp. So don't forget to like, follow, subscribe for future events and tax advice. Visit our website, latercpa.com. Have a great weekend. Keep helping others to help themselves, and let us help you to do just that. I'll see you next time. Bye.
Later CPA and Associates, accounting done great by mates.